In Chapter 15, we're going to be going over the financial statements once again. We're going to look at the multi-step income statement, the statement of owner's equity, and the balance sheet. And also going to be looking at closing entries for a merchandising company, as well as reversing entries. First, we'll take a look at the multi-step income statement. The first thing we're going to enter is the revenue section. And for a merchandising business, the revenue comes from sales, of course. And then we're going to adjust those sales for sales returns and allowances, and you would also adjust for any discounts if there were any. You would subtract the returns and allowances and the discounts from the sales to get net sales. The next section is the cost of goods sold section, and we've been over this many times, but students still have difficulty with it, so we'll go over it again. The cost of goods sold always starts out with beginning inventory, what the company had in inventory to start the year. And then this bigger section here is just simply the purchases that the company made in inventory. So they purchased $244,500, and then those purchases were adjusted for purchase returns and discounts. So the net purchases are $242,500. Then we had to pay $1,300 to get our purchases to us. So we're going to add that to the net purchases to get cost of purchases of $243,800. So we started the year with $103,200. We added $243,800. So all the goods we had available to sell to our customers now totals $347,000. If we take a physical inventory and count the amount of inventory we still have in ending inventory, then the difference between that and what was available for sale is going to equal the cost of goods sold. So to get gross profit, we take the net sales and subtract cost of goods sold to get the gross profit. Now, gross profit is a really important figure for companies because out of this gross profit, the company has to make sure that they can pay their operating expenses, other expenses, and then still make a profit. So the next section is going to be the operating expenses. So the operating expenses are those that are directly related to the company's operations. And they're listed here over on the left. So once we subtract out the total operating expenses, our income from operations is $12,700. Now, sometimes operating expenses can be broken down between selling expenses and general expenses. So selling expenses are those directly associated with selling activities. So, we are in a merchandising business, so sales is how we get our income. It's how we get our revenue. So sales salaries expense would, of course, be a selling expense, sales commission, advertising, bank credit card expense, delivery expense, and then depreciation on the store equipment and the fixtures. Notice this is the store where items are sold. The general expenses are associated with administrative and office operations. For example, the accountant's salary would be a general expense because it's not directly related to selling. So some examples of general expenses are rent, office salaries, office supplies expense, phone expense, utilities expense, insurance, and then depreciation of office equipment or anything related to the office. So once we get all those subtracted from our gross profit, we'll come up with income from operations, and then we have the section for other revenues and other expenses. So remember, other revenues are just revenues generated by the company that aren't associated with selling, like interest, revenue, and any subscriptions. And those are totaled. And then we also have other expenses. So interest is typically an other expense, and that's the one that you will most often see when you're building your income statement. So anything related with interest is going to be under the other category. So if we add the other revenues and subtract the other expenses, so that'd be 12,700 plus 10,003 in revenues minus 1,600 in other expenses, we finally get our bottom line, or our net income, of 21,400. Now that, of course, is carried over to the statement of owner's equity. That statement starts out with beginning capital, and then it ends with ending capital. So the beginning capital that is shown in our capital account, you would have to go to the general ledger and find the capital account and look to see what the month began with. And in this case, it began with 157.2. If you just look at the balance on the trial balance or on the worksheet, it's just going to show 167.2. But that isn't necessarily your ending balance or your beginning balance in capital. You have to look in the general ledger, and that told us that we started the month with 157.2, but there was an additional investment of 10,000, and those will be shown separately here on the statement of owner's equity. So the owner has a total investment of 167.2. And then we are going to add the net income from the income statement, and then subtract out the drawing that's shown on the worksheet or in the general ledger. If we subtract these two, we have 21,400 coming in income, 4,000 going out in drawing. So the difference there is an increase in capital of 17,400. The income, the 21,400, is greater than what was taken out, so we know we have an increase. So taking the total investment, adding the increase in capital, we'll get an ending capital balance of 184,600. Okay, last is the classified balance sheet, and remember, it's called a classified balance sheet because we are classifying our assets and liabilities as either current or long-term. So current assets are always listed first, and that includes cash and other assets that are expected to be converted into cash within 1 year, or either consumed within 1 year. Okay, and then examples of that are cash, accounts receivables, inventory, supplies, and prepaid expenses. Now notice that these are listed in the order of liquidity. That means really the closest the item is to becoming cash. So the speed with which the company can convert the asset to cash is the asset that's listed first, and that is why cash is always at the top of the balance sheet, because it already is cash, and it's usually followed by accounts receivable. So Sunflower has current assets here that total 127.9, and it says here that merchandise inventory is a current asset that is unique to the merchandising business. So if you have a service business, of course you probably won't have merchandise inventory listed on your balance sheet. The next section is property, plant, and equipment, and these are the long-term assets, or those that are going to be used by the company for more than a year. usually it is an asset that's being depreciated. Now, the exception to that is land, because land doesn't depreciate. Land is not going to wear out, so we don't depreciate land. So it could be included in your property, plant, and equipment, but it would not be depreciated. So some examples: land, building, office equipment, store equipment, delivery equipment. Those are pretty easy to identify. So the assets with the longer useful lives are typically listed first, if you can tell what those are. Most often land is going to be listed first if there is any land that is owned by the company. Okay, so the next section here, the property, plant, and equipment. Here we have land listed first, and then the asset historical value, or the cost, with its depreciation right underneath it. So the accumulated depreciation follows the asset, and then the difference is calculated, 120 minus 43. That's going to give you $77,000 as the book value of the asset. Okay, here's the equipment. It was purchased for $48,000. It was depreciated $19,000, and its book value is $29,000. So when you're getting the value of your property, plant, and equipment, you add all the book values up. So the land was 15, building 77, equipment 29. So the total property, plant, and equipment is $121,000. And then when added to the current assets, we have total assets of $248,900. So remember, this is the figure that we're going to be looking for when we get our total liabilities and owner's equity in the next section. So we'll start with current liabilities, and these are just obligations that the company owes that are due within a year. To pay off current liabilities, current assets are going to be utilized. So some examples are accounts payable, wages payable, sales tax payable. Those are typically our current assets. And then notes payable. But you have to know the due date. Is it within 1 year? If it is, it's going under the current section. If it's not due in less than a year, then it is listed under the long-term liabilities. Subscription revenue, or any type of unearned revenue, remember, is a liability. It should be listed with the current liabilities. And then we'll also list the current portion of the mortgage payable. Mortgages are typically due in 15, 30, and sometimes longer years, but there is a current portion that is due, so that will be listed under the current liabilities. So here's the company's current liabilities: notes payable, accounts payable, wages, sales tax payable, unearned revenue, and here we have a current portion of the mortgage payable for $500. So those current liabilities total $34,800. Now the long-term liabilities will be listed next, and mortgage payable is going to be the one that you see most often. You might see a note maybe that has a longer due date than 1 year. Okay, so let's take a look at how that's presented. The mortgage is listed, the grand total of the mortgage is listed first, and then we're going to subtract out the current portion that was listed up under current liabilities, and then the net amount is going to be added to the current liability. So 30 minus the 500 we've already listed here will give us $29,500 in long-term liabilities. And adding that to the current, we get liabilities of $64,300. Now we'll go to the owner's equity section, and we can just pull the owner's equity from our statement of owner's equity. The ending balance goes here. So our ending balance from our statement of owner's equity was $184,600. When added to the total liabilities, we get a grand total of liabilities and owner's equity of $248,900. And remember, that was the same total that was listed for the assets. So the balance sheet does have to balance. Now we'll move on to closing entries. So the closing entries for a merchandising business are pretty much the same as we learned in Chapter 6 when we closed for a service business. There are just some minor differences. So let's take a look at those. We're going to use the worksheet, and just like before, we're going to the income statement section of the worksheet, and the first thing we're going to do is close all the accounts on the right side. So when we were closing for the service business, we closed all the revenues. That was the only account that had a credit balance. But with the merchandising company, we have several accounts that have credit balances. We have some more revenues represented here, and then we also have the purchase returns and purchase discounts that have credits. But you don't have to remember which accounts they are. You just remember it's the accounts that have a credit balance on the income statement column of the worksheet. So ignore income summary and start with your revenue account, and anything with a credit balance is going to get debited to be closed. So we're going to debit all those accounts that we just saw, and then credit income summary as our offset account. So all we needed to do was add the debits and then put that total in income summary. So that's the first entry. The second entry is to move over to the left side of the income statement. So we're going to take everything that has a debit balance and credit it to close it. So we will debit income summary and then credit all these accounts individually to close them. So we can list income summary first and then enter all these credits here to offset the debits on the income statement column. We can then add all these up and then put the total in income summary. So that is the second entry. The third entry is the same as with the service business. We close net income to capital. Now the best place to find the net income is at the bottom of your worksheet, where net income was calculated once we completed the worksheet. In this case, we have a net income of $21,400. So net income increases capital, and capital is increased with a credit. Okay, had this been a loss, this entry would be reversed. We would debit capital to decrease it, and then credit income summary. So remember, if you have a net income increases the owner's investment, so that should be a credit to capital. If it's a loss, then you are decreasing the owner's investment, and then capital would be debited. So that's the third entry. The fourth entry is to close the drawing account, and the drawing will have to jump over to the balance sheet side of the income statement and go down the column until you find the drawing account. Now notice that drawing has a debit, so to close it, we're going to have to credit drawing. So we've got Sam's drawing credited for $4,000, and then Sam's capital debited for $4,000. So that is going to complete our closing entries for the merchandising company. Now, as always, once we have journalized and posted the closing entries, we need to prepare a trial balance after closing. That's called the post-closing trial balance, and that just proves that the general ledger is in balance before we go on to the next fiscal year. And remember, the post-closing trial balance is a lot shorter than the original trial balance because it stops at capital. We have just closed everything below the capital account. So you will technically have cash as your first account and then capital as your last account. And make sure that this is your final capital figure over here, or your trial balance will not balance out. So we should be getting these from the general ledger once we've posted all the closing entries. Now we'll look at reversing entries. Reversing entries are prepared at the beginning of the next accounting period, and the purpose of those is just to simplify the recording of transactions in the new accounting period, given what we adjusted at the end of the previous year. So here's the rule. Only adjustments that have increased an asset or a liability account from a zero balance should be reversed. So in our textbook, so far, there's only been one adjusting entry that has increased an asset or liability account from a zero balance, and that was the wages adjustment. Remember when we had to adjust wages for the amount of wages that were earned by employees but not paid? We debited wages expense and credited wages payable. So that wages payable account is a liability account that had a zero balance before we put the $700 in there. So this is the type of entry that should be reversed. So I'm going to show you what would happen if we did not reverse the entry and what happens if we do reverse the entry. If we don't reverse the wages expense, wages payable adjustment, when we make the payroll payment in the next year, we have to remember that part of that payment is actually for the previous year. $700 of it is. So if we make a payment of $1,100, we're going to debit wages payable of $700 to zero that out, and then we're only going to put $400 in the current year's wages expense. Now, if we reverse the entry right after the first of the year, notice that we have debited wages payable and credited wages expense to reverse, then we have a credit balance sitting in wages expense. Now, when we make the payment, we can just make our normal payroll payment where we debit wages expense and credit cash. And then that $1,100 debit offsets the $700 credit, and we end up with $400 in the current year, which is what we wanted. We'll end up with it either way, but if with the reversing entry, we don't have to worry about a fancy entry in the next fiscal year. We just make our normal payroll entry. Okay, so in your assignments, when you're asked about reversing one of your adjusting entries, you know it's always the wages adjustment, and to reverse, you just simply debit wages payable and credit wages expense.